let's get going. Oh, one more thing, housekeeping. If you're on your phone, it's not going to be as great of an experience as if you could be on a computer, because at one point during the process, we're going to look at a spreadsheet, and even though you can kind of look at it on the phone, it's going to be a whole lot easier if you have your computer. So I'll give you a minute to make that happen. So as you know, we've got background for this is that on March 27th, the CARES Act was signed in by the president, and that's what created these PPP loans in the first place. And then on April the 3rd, we got to, the first applications came in, and then the money's been trickling in ever since. And then there was a second round, and it sounds like that there may be still money left to be had. So so as we look at this, the regulations have been coming out daily. We're up to, as a first count yesterday, they're up to 46 FAQs, and so from the SBA, and so they keep issuing new questions and answers. So we're getting new information every day. The last information that we got had to do with being able to the audit issues. There's been a lot of talk lately about whether or not people shouldn't be giving the loans back if they really deserve them, what they have to do to have these loans forgiven. And so what they came out with yesterday, SBA said, okay, if you got $2 million or more, you're automatically going to get audited. If you got $2 million or less, we're going to assume that you truly deserved it, and that you were harmed by COVID. And so there's not going to be it shouldn't be a problem with the amount that you get in general. Then you just have to figure out how to spend it right so that you can get the most forgiven. So that's what we're here today to talk about. And truly, as the rules are going to change, and they're going to be clarified, but we have to understand what's going on now, because we've got an 8-week window to use to spend this money, and so what my goal today is to give you the best information and the best tools that we know today, so that you can maximize the loan forgiveness as we see it. So one of the things that we believe is that there's the method of accounting that needs to be used is the cash method of accounting, meaning that the day that your forgiveness starts is the day that, or the day that your forgiveness period starts is the day you get the loan, and then that starts your 8-week window. And whatever gets spent in that 8 weeks is what counts for forgiveness. So there's some nuances around that, and some planning that needs to be done. So so that's, we'll talk about that a little bit. And so the planning right now for forgiveness is what's really important. Ultimately, it's the SBA and your bank that will determine what the forgiveness is. But if we can play by the rules as we know them, and use the rules as we know them to maximize the loan forgiveness, then that's what we'll do. So what I'm going to do now is share my screen. I've got some slides that we can talk about, and at the end of this, our plan is to we're going to send everybody, all the participants, the slides and a PowerPoint or an Excel template to use to help you maximize your forgiveness. And I've also got a list of some good links to information that keeps changing, especially those SBA FAQs and things of that sort. And so we're going to send that out to all the participants after this is over. It'll probably be the beginning of next week before we can get it all out, but that's where we're headed. So let's go here. Okay, so here we are with the basic rules of forgiveness. At least 75% of the loan amount needs to be spent on covered payroll costs. We'll go through what those are in a little bit. This is not an all or nothing deal. So it's not, if you don't spend 75% of your loan amount on payroll costs, it doesn't mean you don't get any forgiveness at all. It's just less than what your maximum could be. So don't fret if you can't spend 75% on covered payroll costs. It just means that there'll be some amount that's left on the loan. And remember that, at least the way the rules are now, that the loan it's a 2-year loan at a 1% interest rate, which is not a bad deal. At the end of the day, if you need to keep that loan outstanding and over that 2-year period, or you can just pay it back. Then, so if at least 75% has to be spent on covered payroll costs, then no more than 25% can be spent on other covered costs. And we'll talk about what those other covered costs are as well. Then once you meet those hurdles of you spend the money, the 70, however you spend it on payroll costs and other covered costs, that's your maximum loan forgiveness amount. You can't ever have any more than that amount forgiven. But you can have that amount reduced. And those reductions come in terms of reducing the loan forgiveness due to a headcount reduction. In other words, if you have to let people go, then there's a reduction there. Or if you have to reduce the people that you keep, if you reduce their wages more than 25% of what they had before, then there's a reduction there. So that too, we'll get into that in just a little bit. Okay. All right. Covered payroll cost, and this is up to $100,000 per person. So there's 2 components of payroll costs, but these costs that we're going to talk about first, you have to limit the total amount to $100,000 per person. So let's just talk about gross wages for a minute. So if you just pay straight wages to your people, then anybody that you pay more than $100,000 to in 2019, that's the key is when if you pay them more than $100,000 in 2019, then you can only pay them the 8-week pro rata of that, which is $15,385 in this 8-week period. And so that's the maximum covered payroll cost for that person. So what counts for wages and compensation is there's gross wages, cash tips, equivalents that you have going there, any housing stipend, payment for sick leave or family leave or any of those kinds of things that have come up, especially during this during this quarantine or the COVID period. And then any allowance for separation or dismissal, anything that basically you're going to include on an employee's W-2. So the employee side is relatively simple. When it gets a little bit more difficult is if you have, if you are an independent contractor, or if you have a Schedule C, Schedule F, if you have your own sole proprietorship, you have your own farm, those kinds of things, then you don't pay yourself wages. You just take draws out of your business. And so there again, they're looking at what you earned in 2019. That was how you figured out what your maximum loan was in the first place, was what your Schedule C showed in 2019, or what your Schedule F showed. And so that's how you calculate that again for 2020 when you make those payments. And then for partnerships, it's a self-employment income that gets reported on a K-1. So earnings that are reported on a K-1 from a partnership. So if you're a partner in a partnership, you know that. That's how that works. So that's what is counted for as compensation to be paid during this 8-week period. And the maximum amount that can get paid per person is the $15,383, which is $100,000 divided by 52 weeks in a year times the 8-week period. So that's those, but remember, those are the expenses that are limited to that $15,385. So then there's other payroll costs, and these other payroll costs are, you use these to count into the 75% threshold. So you take your gross, gross compensation, as we just talked about, and then you add to that. And now these are not, there's no limit on these costs for highly compensated people. So there's employee benefits, which are mainly group healthcare coverage, the insurance premiums, those kinds of things. We believe that HSA payments, if you're an employer and you contribute to your employees' HSA accounts, that those count as employee benefits. And then there's retirement contributions, and so those count as payroll costs also. The other small amount is state and local taxes assessed on compensation. What that means in Texas is the Texas Workforce Commission payments that are made. And there again, remember, we're on the cost or on the cash basis, and so you may have paid your first quarter payment to TWC after you got your PPP loan. We're counting those as payroll costs, so that could be a significant number. There again, no one ever really, we didn't really know when we were getting our PPP loans, and so it was a little hard to plan for the beginning of this. But now that we do know, then we can plan. So that's where we are there. Okay, so that was the 75%. So payroll costs, 75%. Then we have other covered costs, and that's what can't be more than 25% of the loan amount. So those other covered costs are your mortgage interest on real and personal property. Now, what the rules say mortgage interest. And so in the beginning, the thought was, well, maybe it's just mortgage interest on real property. We've gotten some interpretations and believe that it's real property and personal property, which means interest on equipment and vehicles and things of that sort can count into this number, as long as the agreement was in effect prior to February 15th. And then we have leasing agreements, and there again, the first thought was, well, is it just office lease, building lease, land lease, for business use and that kind of thing, and believing that now that lease payments for equipment and things of that sort for personal property can be counted as well. Not totally sure on that, but hoping that that's the case. There again, watch out for more guidance. The other item under these other covered costs, other than mortgage interest and rentals, is utilities, and that's electricity, gas, water, transportation, telephone, internet access, those kinds of things for utilities. And so then there again, service must have been established before February 15th. You couldn't have even really, you couldn't have gotten a loan if you weren't in business as of February 15th. So that was the big cutoff date from the absolute beginning. So that's where we are there. So between the at least 75% of covered payroll costs and no more than 25% of other covered costs, once you know what those two numbers are, what you've spent on those two categories, and using the calculations, then that's your maximum loan forgiveness. And then it can only go downhill from there, but it can't go uphill. The first reduction from that maximum loan amount is the headcount reduction. And so basically what Congress wanted us all to do was to keep the people employed so that they didn't have to go on unemployment. So you've got the headcount reduction calculation. And another thing that we're not totally sure of, but we believe that the full-time equivalent is calculated on a 30-hour work week, meaning that if someone works at least 30 hours, they're counted as one full-time equivalent. Now, if they work 60 hours, they're not counted as two. You can only have one person, be for one head count. So even if they work a lot of hours, a lot of overtime, that kind of thing, it's 30 hours or more is one full-time equivalent. Now, if you have someone that works 20 hours a week, then they're 2/3 of an equivalent, of a full-time equivalent. And so that's why you have to do the calculation to see if you've got quite a few part-time people, to make sure that you understand exactly what your FTE number is for all these different periods. And the different periods we look at are the 8-week PPP period, because there again, Congress wants us to keep our people employed so they don't go on unemployment. So that's what they're looking at is, okay, let's see how many average full-time equivalents did you have during this 8-week period. Then the base period that we compare that to is, there's two choices, and we get to use the lesser of those two, so that's a good thing. So the first base period is from February 15th, 2019 to June 28th, 2019. That is basically this same time period last year. So they're saying, okay, if during this same time period last year, look at what your employee count was and your FTE count was, and compare that to your FTE count today. Then look at the second base period, which is from January 1 of 2020 to February 29th of 2020. So if you already had a slowing down of your head count, then through February, then that could be beneficial. So what you've got here is you count your average, you calculate your average FTEs for those two base periods, and then you compare that with your average FTE for the PPP period. And and then there's a formula that you just basically take the percentage of the reduction, and then that reduces your maximum loan forgiveness. There again, we'll look at this shortly. The next reduction is a reduction in salary and wages. So not only does Congress want you to keep the same number or more of heads of people, they also want you to keep the salaries at the same rate that they were in the first quarter of 2020. So you compare your wages that you paid to people, and you only have to deal with people that you paid less than $100,000 to in 2019. So you look at the wages in the first quarter of 2020. You look at their wages in your 8-week PPP period, and as long as those wages during the PPP period are 75% of that first quarter amount, and on the average, then you're okay. If it's less than that, then there's a calculation to reduce your forgiveness as well. But there's a way to cure those last two reductions, and that's by restoring your head count and or your wage amounts by June 30th. How long you have to restore them for, I don't know. There's no guidance on that yet either. And so, more to come, but that's what the rule is. There again, they want, if you can't get your head counts up and your wage rates up in your 8-week period, at least if you can get it done by June 30th, then all is well there, and then you can get your maximum loan forgiveness based on the 75-25 rules. So that's the rules in a nutshell. So what I want to do now is go through a spreadsheet that we put together that we've got as a template, and that we're going to send to everyone for being a part of this call, so that it's easier to calculate these things. So what we've done here is the yellow fields are where we enter information. So we've got, you enter in your business name, and then how much you got. And in this example, this company got $175 for their PPP loan. They also got $10,000 of an EIDL grant. And that's another reduction to the PPP loan amount. And I'll show you how that works as well in the spreadsheet. Because basically the government's not gonna give that to you twice. But the $10,000 EIDL grant, you can spend on anything you want to. And you don't have to pay that back. Also, we'll look at the date of funding, which is April 21st for this company. So then go in and enter in the wages for each of the employees that you have. In this case, we've got a few, and the wages, and this is during the PPP period. So this is week 1 through week 8 of the period, and so this company pays wages every 2 weeks, and so that's those are the wages and this is the projection. This isn't done after the fact. You ultimately could do it after the fact, but if you do it now and project out, then you can make some decisions and maybe maximize the loan, which is what we want. So so we have the wages get entered in, and then you need to enter in also the number of weeks that you expect them to work during the PPP period, whether it's the full 8 weeks or something less. You need to enter in the number of weeks that they worked in the first quarter, so we can figure out the wage reduction, and then what their salaries were in the first quarter. And remember, the only salaries that you put in here are the salaries for the people who made less than $100,000 in 2019. So that's the only ones that count in the calculation. So in our example here, we have quite a few people who earn more than the $100,000. So they're maxed out, and that's where we max out at the $15,385. Then so that's your eligible salaries. Even though the total salaries that you're going to pay during this time period are almost $205,000, only $129,000 are eligible for the forgiveness calculation. So then you enter in the wages from the first quarter of these people who are below $100,000 in 2019. And this calculates your average weekly wage for the first quarter for these people. And then it calculates the average weekly salary for during the PPP period, and then takes a percentage. So some of these people have earned more in the first quarter, but we have one person here who earns less. And so that one's at 70%. So then you calculate what 8 weeks of the first quarter would have, at 75% would have been. And then you take the difference between the $10,464 that should have been at least 75% and the $7,300 that the person received for a salary reduction of $3,164. So that will get calculated into the reduction amount when we get down there. So that's the first part of the spreadsheet, is entering information in by employee. And so if you've got your first quarter payroll reports, you can enter that in and then project out what you think they're going to do, what you're going to pay them during your PPP period. So that gets us that information. Then we go down to the next part of the schedule. And so we've got our eligible salaries that was the number from above. That was $129,000. Then we project that we're going to pay $10,000 in health insurance and $500 in state unemployment tax and $6,000 in a retirement plan. Now we've got a couple of lines here that are blank because we're going to use those to plan with if we pay some extra wages and bonuses and extra retirement contributions when we start doing the planning part. But this is just what we normally would do, and before we start playing around with it. So then you have your total payroll cost of $145,000. So we look at, and remember, we have to spend 75% of the loan proceeds on payroll. So we've got our total loan of $175,000. 75% of that is only $131,000. So therefore, we've already met that threshold. So we're in good shape there. So of the $175,000 loan, we're going to spend at least $145,000 on payroll. So we have $29,475 left to spend on other items. So now we say, okay, if of that $29,000, what are we going to spend? So our rent is only $15,000. Mortgage interest is $2,500. And remember, don't get confused here and say, well, why do I have rent and I'm sorry, mortgage interest is only $1,000. Utilities is $2,500. Utilities is $2,500. Mortgage interest is $1,000. You can have mortgage interest because we believe that you can count the interest on your equipment and vehicles and things of that sort. So that counts in that number as well. So then the total amount of these non-payroll costs is $18,500. So basically, if this is all you do, then there's about $10,975 that won't be forgiven in this scenario if you don't do any more planning. But so then we calculate. We go over here and we take our $175,000 loan again, and then we say, okay, well, how much of our loan amount over here is not paid for covered costs? So we subtract that to get from the $175,000 loan to get to the maximum loan forgiveness. So remember, that's the maximum is based on what you spend the money on, the 75% and 25% rules. So at this point, if nothing else is done, that's the maximum amount you've got that can be forgiven. So then we're going to go to the next spreadsheet, which is a little busy. If you think this one's busy, the next one's really busy. But basically all you enter into the next one is hours by employee to get those base periods, so you can come up with what your lowest average FTE was for those two different base periods, which were, February of 19 through June of 19, or January of 20 through February of 20, and then calculate what your FTEs are during your PPP period and figure out what your reduction might be. So let's go over here. We're not going to linger here long, but basically put your business name in here. This is where we've entered in what we believe is our base hours for FTEs is 30. If we get guidance that changes, we can enter that number in here and all of our calculations will change. But if you just look at this one line, so this is during our PPP period. So we've got an employee A is going to, that person's going to work 20 hours a week for the entire 8-week period. So basically they're at 0.67 FTEs, and that's their average FTE is the 0.67. So then you go down and you enter all your different people in as you hire them and fire them and they leave and all those things during this PPP period to get to your average FTE here. Then you're going to do the same thing during the two base periods. So you've got the first base period we've got together in kind of two sections so that it's not so ominous. And then the second base period we have down here in the bottom for the January of 20 through 2/29 of 20. And it just calculates what your average FTE is. Then those, and it calculates the smaller of the two base periods. And so then it takes those numbers over here to calculate what our head count reduction is. In this instance, our head count reduction was 0.25. So then you take the 0.25 reduction divided by your baseline, and that was a 2.34% reduction in head count. That amount is then multiplied by your maximum loan forgiveness that we get up here. And so that's an extra reduction in your loan forgiveness. Then your salary reduction amount above here, that was the number that we calculated up here through the salary reduction. And because we've reduced this person's salary a little bit during the period. And so you started out with a $175,000 loan that you could potentially be forgiven, but you didn't spend $10,975. So now the maximum amount is $164,025. But then we reduced headcount here, so we get dinged for that for another $3,800, and then we reduced salaries again, so that dinged another $3,000. And then this is also where your EIDL grant comes in. Remember, you can't double dip on that. So for your EIDL grant of $10,000, that reduces your reduction also. So now at the end of the day, what you've got is your maximum loan, that your loan forgiven will be a little over $147,000. And so your remaining debt is right at $28,000. But remember, of that $28,000, you got $10,000 in the EIDL grant. So that's your first pass at this. So then the next thing we need to think about is, what can we do to maximize the forgiveness? What can we do to tweak this spreadsheet and that falls within the rules to make sure that we get the maximum that we can? The first thing that needs to be done is, let's go up here and talk about wages. This company, the way they got their wages and the way they pay their wages set forth, they actually, this company is a semi-monthly payroll company, or they pay their employees semi-monthly, meaning they pay them on the 15th and the end of the month. And because they got their PPP funding on April 21st, and then their next payroll was April 30th, the next one was May 15th, the next one's May 30th, and then, or 31st, and then the next one's June 15th. Well, they just squeak in right at the end of their PPP date, period. But what if they'd gotten their funding on, say, April 16th, right after they had done their April 15th payroll? Their last payroll would fall outside of the 8-week window. And so what we're advising people to do is pay attention to that and make sure that last payroll, if you're in that position, that last payroll gets scooched back in, and you pay them a little early, and so that you can get it into that 8-week period. Because if you don't, in this regard, I mean, they could lose, $40,000 of loan forgiveness. Maybe not quite that much, because they've got high wage earners, but still, it could be significant, depending on how much you pay, what your payroll is on that basis. So the first thing you need to make sure of is map out from 8 weeks from when you get that loan, and figure out how you're going to pay your people, and then figure out how you're going to pay all these other expenses, from the health insurance to the rent to the mortgage interest to the retirement plan contributions, all those normal things that you pay. Make sure that they all get in that 8-week period. So now let's assume that we've done that. So all of these payments are in here for that period. Then what do we do? Because we're still short, and we're short $27,000, $28,000. So how do we fix that? There's the one way to fix it is to up your, or to increase your wages for your people, hire new people if you need to. I've got a couple of clients that have hired new people to do some things that they really needed to have done, but just hadn't had their people do those things, and didn't have enough manpower to get those things done. So they've hired some extra people, and there's people unemployed, as we hear every day. And so they've hired some extra people to do some special projects that truly need to get done, to maybe set them up to win when we come out of this. So that's definitely something that can be done. or bonus out the people that you have. A lot of companies wait until the end of the year to do performance bonuses and profit sharing bonuses and things of that sort. What's to say we can't pay those during this 8-week period, and reward our employees for all the craziness they've been through. If you need to pay them some sort of hazard pay, the ones that are truly coming in and being on the front line, and that makes some sense for your business. And those kinds of things. So there's bonuses that can be added. Also, extra retirement plan contributions. Make sure that if you haven't paid your 2019 retirement plan contribution, we believe that since we're on a cash basis accounting here for these 8 weeks, that you can definitely pay that in this 8-week period, and it should count. And the same way, if you want to front load some of your 2020 contributions, we believe that can work as well. That they may come back and say that doesn't, but working on good faith, I think you've got an argument. Because remember also, at the end of the day, the way it's written in the rules right now, there's a narrative that's going to have to go in with the forgiveness calculation and the forgiveness request. And that narrative is going to say things like, in the beginning, this is how we believed that the virus and the pandemic was going to affect our business, and how it was going to hurt us, and what and what the ramifications could have been. And even if you're under 2 million, I think it makes sense to do that, and then talk about how these expenses were beneficial to your business and how they truly benefited your employees. There again, remember, this was about helping America get back on its feet and keep employed. So we believe that there's a lot to be said for that. So paying extra wages, hiring new people, and paying extra in retirement contributions, those seem to be in with the spirit of the legislation to begin with. Then the other things that can be done are you can pay, if you can pay rent early, maybe that makes some sense. Extra utilities, things of that sort. Those are a little bit more difficult, but definitely being able to pay your people more. And those are they're, at least in our business for sure, they're our main assets to begin with. They're our people. So, and there's a lot of people out there that are hurting. So, so it's a good thing. So let's see what we can do with this one to maybe try to lower this remaining debt down to as low as we can, which would be the $10,000. That's our goal, is to get that to the $10,000, which is the EIDL grant. So, and it's not going to take us much, over here to get the payment up. So if we can do some bonuses of, let's say, $8,000, and then some retirement contributions of, let's say, $3,000, then here we are. Now we're at zero. So there's nothing of the loan that we've received that we haven't spent on some sort of covered cost. And the majority of it, yes, has gone to our employees, which they're, again, in the spirit of the law, that's what Congress is wanting. So, and that's, again, what makes sense to our people. So we have the loan amount. There's nothing that we didn't spend. And then we have the $175,000 that's totally forgivable. Then all we have to do here to get rid of the $4,000 reduction in headcount and the $3,000 salary reduction is go up, and it's specific to this person for this $3,000. All we have to increase her salary by is $500. So she's got in week 8, she's at $1,500. If we pay her $2,000, voila, it goes away, because her percentage is at 75%. So that can really make a difference. Now, if you want to do that at the end of week 8, or if you want to wait until June 30th, that's up to you. But just know that those numbers, it doesn't take much for some of these people to get them up to the 75%, and then there's no reduction at all. And then here on the PPEs, or I'm sorry, on the FTEs, the so many acronyms. On the FTEs, just hiring someone back and getting your FTE back up to the 10.67, which hopefully by June 30th you could do that. And so let's say we're going to override this calculation. Alex will shoot me for doing that because his fabulous calculations. We're going to do that anyway. So now you've got your FTEs up, and so there's no reduction there. Your only reductions for your EIDL grant that hopefully you received. And if you didn't receive an EIDL grant, then this doesn't come into effect. But if you did, that's where you go. So then your remaining debt is only $10,000, which is what you received. So you received $175,000 on a PPP grant. You received $10,000 from the EIDL grant, and so the grant, the $10,000 grant, is a grant. You don't have to pay it back, and so you have to pay back the 165, or pay back the 10. So you get forgiven of the 165. So the total amount you get forgiven is the 175. So pretty good deal. Pretty good deal. And that's the way you make that happen. So I think we've got a little bit of time for questions. The only other things that I would reiterate are on the maximization techniques. Thinking this through, and basically remember that it's the cost basis of accounting that we're using for that 8-week period. Make your start your period right that day that you get that loan. Count your 8 weeks and just really pay attention to everything that you spend and that you need to spend the money on. And then your bonuses to employees, extra wages to people, hazard pay, and interesting things like that. So I'm getting my questions, and then looking at retirement plan contributions and prepaying rent and utilities and things of that sort. So I've got a couple of questions. We'll get off. We'll stay on this because it might have to make sense to go there. So one question is, can payroll expenses exceed 75%? And yes, they definitely can. As the 75% is just the floor; it's not a ceiling. I mean, if you had no rent, no utilities, and no interest expense, those kinds of things, you could spend the entire 100% on employees and these covered costs, and that would be fine. As long as you spend 75%, that works. And so let's see, it says, are the other 25%, other costs 25% of the loan, or 25% of the payroll costs? It's 25% of the loan. It's 75% payroll costs, 25% other costs, and the percentages of the maximum or of the loan amount that you received. Insurance premiums, question is workers' comp insurance included? I don't believe so. There again, we've got some, we probably need some guidance on that. It was really more about benefits or health insurance and things of that sort that we understand those are. Let's see. Do you have to have the same people back, or can you hire different people? What if someone doesn't want to come back? That's a great question. There's just been guidance out about that, and that's in one of the newest FAQs. Is, let's say you have someone that you want to hire back, and to get your FTE count back up, and all those kinds of things, and they say, you know what, I kind of like being on unemployment, and I don't want to come back to work for you. You can document that, and then that won't count against you, and it might count against them because that, I think, is maybe unemployment fraud. But anyway, so that's the deal there. So those aren't going to count against you. Let's see, is FTE 2,080 for each individual, 30 hours, okay, or 40. We think that the FTE count is the 30 hours a week, as opposed to 40 hours a week. And the reason we believe that has to do with some other SBA regulations that say a full-time equivalent is 30 hours a week, not 40 hours a week. Let's see. The start date of the loan, is it the day the loan gets approved, or is it the day the money gets into your account? It's the day the money gets into your account, because even though, you know, sometimes the approval took a while, and it took a while for the money to get into the account, because remember, banks had 10 days to get it into your account after the approval was received. So some banks were quicker than others. So, okay, another question. Are CAM expenses included in rent, common area maintenance charges? I believe they are. I think that's part of your rent agreement to begin with. That's normally how that's in place. So, so that's where those are. Then let's see if I've got anything else. The other one, I'm getting more questions. Y'all are good. Oh, when do you have to apply for the loan forgiveness? There's a timeline for that. Obviously, after the 8-week period, but I think you've got, something makes me think that the entire process, in terms of from when you receive the loan until the maximum time that the government has to tell you that they've forgiven it or not, is 7 months. And so that's actually a month longer than what the 6-month interest forbearance is, or forgiveness is. So I don't have that, but I'll get that out to everybody. I'll make sure we get that out to y'all. Okay, self-funded health plans. Can you include what's reserved and set aside in a separate bank account? That I'm not sure about that, Steve, on the self-funded health plans, what's going to count, if it's just the carrier and the fees, or if it's the reserve account. We'll look at that one as well. Good questions. Okay, question is, okay, if you received the PPP grant, and in this example, the $175,000, and you received an EIDL grant of $10,000, you shouldn't have to pay the EIDL grant back. That's true. You don't have to pay that back, but you would have to pay back the $10,000. In this example, you would have to pay back $10,000 on the $175,000 PPP loan, because you got the $10,000 grant. They're not going to give you both. They're not going to give you $175,000 plus the 10. They're just going to give you the 175 maximum. So I think the deal was, it was kind of either or. And remember, in the beginning, those EIDL grants were supposed to come in 3 days. And, you know, we were talking about those as maybe those are kind of like a prepayment on that PPP loan. But everybody that I've talked to has gotten their PPP loan before they've gotten their before they got their EIDL grant. So that's an interesting one. Let's see. For retirement, are employee contributions and loan repayments excluded? Employee contributions don't count. This is for retirement contributions. It's just the employer contribution. So let's say you've got an employee who their salary is $5,000 during this PPP period, and then they contributed $500 into the retirement plan of their money. You know, that's taken out of their gross payroll already. So it's just their gross payroll that counts in the calculation. And then the matching amount that the employer makes to the, so it's employer contributions are what count in these numbers here for your employer retirement plan contributions of, it's just employer contributions, not the employee part, because that's already actually counted in their wages. 30-hour requirement for hourly or salaried employees. Yeah, because it really doesn't matter what their hourly or salaried are. It's what they truly work. And so whether it doesn't really matter how you pay them. It's the 30-hour threshold. Let's see. On a triple net lease, can a portion of the property taxes be included as rent? Um, if that's what your total, if your total rent includes the property taxes and everything on a triple net lease, I don't see why it wouldn't count. That might be a little bone of contention with the SBA, but it seems like it would. It's just a definition of how that rent, you know, how the rent gets paid. So I would think that would make sense. Okay, question, if we've had a resignation, do we have to employ a person in the same position or just maintain the FTE count? It's really just FTE count. It's not, they're not worried about position by position. The only one that where you have to deal with the specifics are, remember our gal up here that we had reduced her wages down to 1,500, and then we got dinged up here. She's the one that we have to increase the wages on to get rid of that. So that's the one that's more of a specific kind of thing. Question, should you put the loan money in a separate bank account? That's ideal to do that. A lot of banks are so overwhelmed with just dealing with all this. They're pushing back a little bit at opening up another account. So if you could at least segregate it into some sort of other account other than your operating account, maybe a money market account of some sort. But the other thought about it being in a separate segregated account is if and when you have to prove all of this thing, all the expenditures up to the SBA, then they only have that one account that they can look at, and it's just the PPP money coming in and then the PPP money going out. Then to go, normally what we're seeing people do is they do a transfer out into the operating account, and they have a calculation in a spreadsheet that says, okay, this is my, you know, like kind of like on an interim financing law. This is loan. This is draw number 1 on my PPP loan. You know, this pays for this payroll and this retirement plan expense and those kinds of things. So as long as it's pretty well documented, or really well documented, with receipts and invoices and all those kinds of things, we believe that that's gonna do you well. Oh, here's a good one. Can we include costs of supplies for disinfecting the office and supplies for employee safety? That's not included in the rules. I probably should be, but don't. We haven't seen that. Another one, can we pay 3 months of rent in the 8-week period to make the 25%? I think if you need to, if that's the only way you can make it work, you can try that. And I know people are going to do that. I don't think I'd pay 12 months of rent. You know, we in the tax world have a saying that, you know, pigs get fat and hogs get slaughtered. So just be a little careful and don't get too egregious with this, and you'll probably be okay. So looks like we have 3 more. Can you include the 2019 final retirement profit sharing plan contributions? I think you can. If we're on a cash basis, you know, form of accounting, then I don't see why you couldn't. And that there's a lot of people that haven't made their 2019 profit sharing plan contributions. So I would definitely try that. Short-term and long-term disability premiums, not seeing that, but it's part of a benefit and insurance. So definitely worth a shot. And think this through. You know, if you know the more you put in there, as far as what you spend, you know, over and, you know, especially if you're over and above, you know, the maximum with the 75-25 rules, you know, let them knock something out. Then you've got something else to fall back on. So you know, just, you know, do, you know, work as much as you can, but there again, you know, don't get too greedy. And then let's see. You can't deduct as an expense wages paid from a PPP. Can you count those wages against the amount of wages used in the maximum QBI calculation? Okay, I'm not sure I quite understand this question, but let's talk about taxability for a minute, because we didn't talk about that. So when the rules came out, they said, okay, any PPP loan forgiveness is not going to get included in your gross income. And so it's like, okay, so we get the money and we don't have to include it in our gross income. That's great. And then the question became, but do we get to deduct the amounts that we pay for all these expenditures in this calculation? So we get $175,000 of PPP forgiveness, more, at least 165. So then do we get to deduct those $175,000 worth of expenses? And they've come out in one of the FAQs and said no. And honestly, that makes sense, because it's money that you were given, you didn't have to pay tax on it, and so therefore you shouldn't be able to deduct the expenses that were incurred when you spent that money. So it's gonna affect, because the question here was about the QBI deduction. It's gonna affect that QBI deduction, just because it depends on, that's based on what your income is. And then it's also based on the wages that you pay. So I would imagine that there's going to be further guidance on that, but hopefully we'll get something on that before we have to do tax returns for next year. That's assuming we ever get to finish tax returns for this year. So anyway, I think I am out of time. I so appreciate you joining us today on our very first K-Ford Group webinar. But there probably will be more to come, because there's just more information coming out all the time, and we'll try to do these every so often so we can keep everybody informed, because that's our goal, is to give you guys as much financial peace of mind as we can. So thank you again for coming. We hope you have a lovely rest of the week and weekend, and stay safe out there. Bye now.